Hi, everyone. Sandra here with the Mortgage Center. Sorry, I am a little bit late. I had a busier morning than I expected, but it's so great for you guys to join us. We are we're gonna start. We have about 30 people registered for this webinar, and we will greet the people when they join us. So here we go. Let me just share my computer screen with you and we'll get started. How are you guys holding up with the market? You guys okay? And it is a tricky time right now. So let me just have a look here. I'm going to share my computer screen with you. Okay, here we go. For those of you who don't know me, I'm Sandra. I'm the principal broker with the Mortgage Center, and I love working with realtors, and I especially love working with realtors who have done an excellent job at keeping their skills sharp. So I just want to commend you for being here. I know the market is not as busy as it was even 6 months ago, and we just love working with real estate agents. So let's get this show on the road. So today's topic is what you as a realtor should be thinking about when you're helping a self-employed person buy a house. So there have been a lot of changes in the last couple of years because of the pandemic. So, people have decided to. So just to kind of give you a little bit of background, we're going to spend about 15 minutes going through this information. By all means, if you have a question, just put it in the chat, and I'll keep my eyes open for that. And if you have any questions, just put it in the chat. But I'm going to go through this quite briskly. It'll be about 15 minutes. And the last 5 minutes, what I'll do is I'll just kind of do a quick look at what's happening with mortgage interest rates, because I know you guys are curious about that. So as I was saying, a lot of things have changed with people's employment. We're starting to see, as always, fewer and fewer people who are actually employers of large corporations, and many of people have, side gig. I had a gentleman that I did a mortgage for, and his side gig is now actually making more money than what he does for when he goes to the factory and works his factory job. Also, there have been changes where we're starting to see a lot more people who were T4 employees, and the company has restructured things, so now they're subcontractors. So we're starting to see more and more of that, probably because of the pandemic. And also the fact that, although the unemployment rate is very low right now, we have started to see the unemployment rate creep up. And we're going to, as inflation continues to be a persistent issue, what you might end up finding is that employers are going to slowly start to people aren't going to be buying goods as much, and then you'll start to see the unemployment rate creep up. So I also wanted to remind you the difference when you're looking at just anybody, it doesn't matter if that person's self-employed or not, is that what you want to do is understand the difference between a pre-approval certificate and a pre-qualified certificate. The Mortgage Center, we have a really great mortgage app where you can run a pre-qualified certificate. You can even run it for yourself. Just go to my website at skipthebank.ca, and you'll see on the top right-hand corner, it says download the app. You can run some numbers for yourself. You can even run some figures for your clients if you wanted to. It's a really great app. It's available, and I'll put this in the chat right here. It's available on my website at skipthebank.ca, and you can just go to the website. On the top right hand corner, it says download the app. It also gives you an idea of what's happening with mortgage rates in real time. A pre-approval certificate is way more important, especially for self-employed people. And the reason for that, if you think about what's the difference between a pre-approval certificate and a pre-qualification, is that we actually look at the 5 C's of credit. And so here's a reminder for you guys on what the 5 C's of credit are. So we actually do a credit check. We verify down payment because for a lot of stated income programs, so for those folks who are putting less than 20% down and they're looking at like a stated income program through an insurance, like through the insurers like CMHC, SAGAN, and Canada Guarantee, the down payment is important because they will allow stated income with 10% as a down payment, but 5% needs to be from your own resources. Okay, so we verify the down payment, and remember, we need a 90-day history. So again, gifted down payment for self-employed people, if they're putting less than 10%, if they're putting less than 20% down, 10% is the minimum for stated income, 5% from own resources, the other 5% can be gifted. Character is related to the job stability, and I'll get back to capacity. So character, for example, all lenders are looking for a 2-year history for job stability when you're self-employed. So, something to keep in mind, especially like if you don't have 2 full years of self-employed history, um, you're probably looking at alternative financing, and the minimum down payment for something like that is between 25 and 35% as a down payment. Again, if you're looking at refinancing a property, you're probably looking at 65 to 75% of the appraised value. Okay. Capacity is super important also in when you're self-employed, but more importantly is understanding what kind of income the self-employed individual has, and what category and how to present that income. And then the last piece of the 5 C's of credit is collateral. So I get this question a lot from not only first-time home buyers, but for realtors. Well, the people have been pre-approved. How come we need a financing condition? Because if there's any issues with the collateral, so for example, some of the issues around collateral are often related to like knob and tube wiring, asbestos. We just had somebody put an offer on a property that had some minor asbestos, so we had to deal with that. It was a high ratio mortgage. Collateral, it could be regards to valuation. So remember, like we're in an environment right now where we're not seeing a lot of, multiple offers. But so we always recommend if you can, and if you're not in a multiple offer situation, there's no reason why you can't put a financing condition. And usually we can get kind of things wrapped up in 3 to 5 business days. I always tell real estate agents, ask for 7 business days from the time the offer is accepted for the financing condition. If we get it done in 2 or 3 days, we look like a rock star, but then we don't have to have an extension on the financing condition. So this is especially for you guys as a realtor. So here are some trigger points for mortgage issues. So when you're talking to a client and they bring this stuff up, these are some trigger points where there will probably be problems, and you need to make sure you get them to a mortgage brokerage like our office, the Mortgage Center in Guelph, and we can uncover the issues so that when you're putting together an offer for these buyers, you feel confident about the offer, and we've done the extra due diligence. So we try to avoid as many problems as possible. And part of that is being proactive. And I wanted to digress here a little bit. I love this ad. When's a good time? It's not an ad, it's a cartoon. When's a good time to get a mortgage? Well, back in 1952, with the market how it is and the propensity of fraud, I just got off the phone with somebody who's self-employed, and they're co-signing for their kids. And they've owned a corporation for like 15 years, and they pay themselves a T4 income, and they're like, why are they asking for audited financial statements? It seems like it's overdone. And I would have to agree. So, as a mortgage broker, like we do mortgages for like TD and Scotia. We have access to most wholesale banks and other credit unions. Sometimes we can negotiate the conditions. So that's one of my jobs for today, is to try to see if we can get any of the conditions removed from the co-signer who's self-employed. Okay, but so here are some trigger points for mortgage issue that will present some issues with people who are self-employed. The most important thing related to self-employed individuals is understanding how to present the income. Okay, and there are different categories of self-employed people. Okay, so there's a sole proprietor whose gross and net income appear on their personal tax returns. And what we would need in that case is 2 years worth of T1 generals, all 30 pages, including the statement of rental activities. Okay, aid lenders want everything, because what happens is not only so if they have rental properties, a statement of rental activities, but as it relates to sole proprietor and business activities, their business activities, their gross and net income, and all of the sort of the financial advertising, what they write off, appears on their personal T1 generals. And what's really neat is the reason why we need the full 30 pages, including the statement of business activities, is when we see all the write-offs on the T1 generals, we can add some of those things back. So for example, like if the person's grossing 200,000, but is only showing a net income of 50,000, and there are some expenses that we can add back to the income, that $50,000 worth of income might end up being more like 60,000. Okay, so that's why if we have the full picture, then we can work with the lenders to see what add backs we can add to their income, because an A lender is only going to look, if it's not a stated income program, is only going to look at their net income, and it's a 2-year average. For all A lenders and alternative lenders, private lenders not so much, but they will need their notices of assessment, because if there are any outstanding personal income taxes, those need to get paid prior to funding. Okay, and sometimes financial institutions, like if there's only a couple of thousands and they're on pre-authorized debit with Revenue Canada, they will allow that to go, but we need the NOAs and we need to make sure the taxes are paid. Now, I have also refinanced properties for people to pay off their Revenue Canada. Sometimes it's as small as 5 or 10,000. Other times there might be $100,000 worth of outstanding taxes. We see some ugly things. Many subcontractors fall in this category. So I have a gentleman, a client, he works for an American company. He is the only Canadian employee that works for this American company. And how the arrangement that he has with this company is that he's a subcontractor. So he's considered self-employed. And then we also need 6 months business bank account statement. So I did get a client, there was a client this year that I just recently worked with, and they provided us with 6 months of bank statements, but they weren't business bank statements. So I think sometimes sole proprietors chintz out. Instead of getting a business account, they used a personal bank account, and we managed to sort that out. But if they don't have business bank statements, we need all of the invoices related to all of their income. And this gentleman was a tattoo artist, for example. So like he was seeing maybe 10 people a week. So can you imagine 10 times that many weeks over 6 months business bank account statements? It became a paperwork nightmare for him. We were able to figure it out through a private loan instead of just a traditional bank loan or even an institutional loan, but it cost him more money on interest. Okay. So that $20 that he was chincing out on ended up costing him more money. And so that's sole proprietorship. The next category is corporation. And these are individuals who own a corporation for tax purposes. And what happens is their income and expenses appear on their corporation P&L statement. And they would pay themselves T4 income and dividend income. Okay. So sometimes self-employed people say, well, you know what? I'm paying myself a T4. Why do you need this stuff for the corporation? I can tell you if the client wants a better rate, they will, uh, if they provide us with their corporate stuff, they will get a better rate. But if they're kind of have an issue with that, then they're going to end up going through alternative lending. So we can use T4 income and dividend income to support that. Manulife, so we also do mortgages for Manulife, and Manulife has a really great product for self-employed individuals where normally the total debt service ratio can only be 40% or 44%, they will actually bring the TDS up to 70%. And they will allow the borrowers to access up to 65% of the value of the house. So like if somebody's house is worth like 1.5 million and they only have like a $200,000 mortgage, and let's just say their own bank like RBC or TD or BMO or CIBC has declined them, we can actually help them access probably close to 65% of the value of the property. So that what that ends up doing is it ends up freeing up cash or equity in their home so that they can buy other properties or reinvest in the business. And then I have seen some realtors who have professional corporations, and that's just something new. Um, so if you have any questions about that, please just let me know because I can help you with if you're having trouble qualifying for a mortgage because you've moved from a commission salesperson to a corporation. Just give my office a call or book an appointment with me and I can kind of walk you through that to let you know how you can qualify for a mortgage. And then there's the last category, which I guess is technically self-employed, but it's commission salespeople, and realtors are commission salespeople. There are many car salespeople. So anybody on a full commission where there are no source deductions. So sole proprietor is a little bit different than a commission salesperson because commission salespeople generally have one employee, I guess, employer or work for one company. So these trigger points for you as a realtor. So these are the things that you need to watch out for. Okay. I don't show a lot of taxable income. What do I do? Well, this is a common problem with self-employed people because self-employed people in their mind, like if they look at their gross income, I call that the bling number. Gross income. So you might be grossing 100 or 200,000, but if you're only netting, let's just say 30,000 on your tax returns, all A lenders will look at that 30,000. And I mean, it depends if you're a sole proprietor or a corporation, but that's often a challenge. And there are some really good stated income programs, but you also have to state what's reasonable. So if someone's making 150,000 and they're only netting 20,000, you cannot state 150,000, right? We have to go through the bank statements, see what would be reasonable, and maybe in this case, a stated income program would be 60 or 65,000, something like that. So that's a watch out. This is another watch out, and I love these cartoons. This cartoon says, "That's not good. When I pulled your credit, it gave me a computer, gave my computer a virus." So, for self-employed people, it's uber important that they have good credit history because if they're showing sort of variances in their income or they meet a stated income program and they've had credit issues in the past. And now they said they've cleared it up. They may have cleared it out 3 or 4 years ago, but it's still showing up on their credit history. So we're actually just working with someone right now who is a first-time home buyer, and I call it like young and stupid. Oh gosh, we had a whole explanation on why he missed a credit card payment like 4 years ago. So, and it wasn't just a one payment. We can see on the credit history that it was in delinquency for 5 months. So what was the reason for that? So again, if when you go back and you're looking at the 5 C's of credit, the one capacity where the debt ratios, if we're asking for exceptions on the debt ratios because of how the self-employed person declares their income, and then we're also saying asking for exceptions on credit history, you're looking at, again, alternative financing and maybe private financing. Another kind of watch out for you is if you have a client that says, oh, I want to put an offer on a house, but I haven't completed my income taxes, or I'm owing to Revenue Canada. I'd say I know you guys want to go ahead with the buyer, but they need to get that done. And a lot of private lenders now, I mean, if you're not going to pay 15% because you don't have your income taxes done, and I know very few people who can actually afford that, you want to go back to your buyers and say, you know what, you got to get your financial house in order and get those taxes done. And I mean, we could use COVID as an excuse for a while, but the lenders aren't buying that anymore. The other kind of watch out for you guys is I just started my business 2 years ago, or it hasn't quite been 2 years. There are some good lenders that will, and again, these are alternative lenders that will look at income if they've worked in the same industry. So for example, I'm working with a psychologist right now, and he used to be an employee of a company, and just within the last 2 years has started his own practice. So he's gone from being like a T4 employee to a sole proprietor. We can get some exceptions with income if it hasn't been the full 2 years, but it's within the same industry. Okay. And again, I'm talking about people who have more than 20% down, because high ratio mortgages, so those people who have less than 20% down, there's a lot less wiggle room, because not only does the mortgage have to be approved by the lender, it has to be approved by the default insurer. So for realtors with their buyers, here's some final kind of tips for you. Be proactive. If if you're talking to your buyers and you're not really confident that they in fact have a pre-approval, always just say, hey, you know what? Let me introduce you to the mortgage center and let's just get a second opinion on that. The other thing you want to understand is, will an appraisal be required? I can tell you in 99% of the cases, when it's a conventional mortgage where they have more than 20% down, an appraisal is normally required. You also want to know like what their employment status is, like how recently have they become self-employed. Usually companies who are 5 or more years, or somebody's been self-employed for 5 or more years, they have their kind of stuff together. But if they've only been, self-employed maybe for 3 years, they may be not up to snuff with their taxes yet, because they're still trying to get the rhythm of getting their taxes done as a self-employed individual. And then obviously you want to ask them, like, do we have a pre-approval certificate? Like what's been done. So that if it's a client of ours and we're working together, I always tell the buyers, is it okay if I loop back with your realtor? Or please introduce me to your realtor. And likewise, if you have a client, I really believe that it's super important to have the communication lines open between the realtor and the mortgage broker. And our office, we do a great job at that. So let's I'm going to just spend the last couple of minutes looking at interest rates. I hope you don't freak out. We work with a lot of wholesale banks, and one of the banks that comes to mind is MCAP. I would call them the wholesale division of Bank of Montreal. I'm just going to review their rate sheet quickly. And the reason why I'm doing this is just to kind of give you a sense of like what the different categories are for interest rates. Give me a second here. I'm going to put it on the screen, and this will give you a good idea of, again, what's happening with mortgage interest rates. So here we go. I hope you guys can see that. Let me just do one more time. So I want to share this screen with you. Let's make sure we're doing a good job for you guys. So okay, so I hope you guys can see this. If you can't, can somebody message me in the chat and say, hey, I can't see that. This is MCAP. They are one of Canada's largest monoline lenders or wholesale banks. They have a few investors, but their main investor is Bank of Montreal. So their products are very similar to the Bank of Montreal. And what I wanted to show you here, so this was, so we just got this new rate sheet. You can see here rates effective as of September the 27th. These rates were about 0.25 less last year. So you can see here, these are just for 5-year fixed rate mortgages. And the gray area or the blue area denotes recent changes. So remember, MCAT, for example, has 3 categories. They have their standard mortgage. They have something called the value flex. And what's really interested in, you can see on the variable rate mortgage, the interest rate is just a little bit lower. This value flex mortgage is very limited because you cannot, it's very difficult to refinance. And the only way you can get out of it is when the term is over or when the borrower sells their house. And I actually did a mortgage for somebody. Thankfully, they didn't originally do the MCAP mortgage through our office, but their broker recommended the value flex mortgage and they had to refinance and didn't qualify. So they only had like $100,000 mortgage on their house. And the value of their house was like 800,000. And they needed about 50,000 to access the equity in the house to pay off some of their credit cards. And they didn't qualify because their income had changed. And that's why they were in debt. So we had to do a private second mortgage for them. And instead of the interest rate being like 5 or 6%, it ended up being 12%. So again, most financial institutions have a standard rate, those low rate basic or kind of limited mortgages. And then MCAP also has a mortgage that has a line of credit component. Okay, so like a fixed or variable and a line of credit component. So you can kind of generally see like the insured mortgages right now and up to 65% of the value. So this category up here is for purchases with less than 20% down. This category in the middle here is for purchases that require a 25-year amortization or transfers from other institutions for renewals. And then here, this uninsurable purchase or transfer, this is for people up to 80% that require a 30-year amortization to qualify. So, generally you can kind of see what's happening with interest rates. Shorter term rates right now are higher because we're in an inverted yield curve. So like sometimes people say, oh, okay, well, what's your 2-year or 3-year fixed? It's more like 5.64%. Okay, because again, this inverted yield curve, because the prognosis for inflation for the near term is higher than long term. So that kind of gives you an idea of what's happening with interest rates. I just wanted to let you know. Oh, I've got a question here. How much is the maximum amount of amortization period we can get with 20% down? It's normally with 20% down, you can do a 30-year amortization. There are some lenders that will, alternative lenders that will allow 35-year amortization. So I hope that answers your question. but usually it's 30-year amort, 25 or 30-year amortization, sometimes 35 alternative financing. That's it for me today. Thank you so much. I want to respect your time and your busy schedules. We love helping realtors. If you like this webinar, I'd go to our, if you do a Google review, just Google the Mortgage Center Guelph and provide us some feedback there. And we will also post this on our YouTube page. I think we've got about 40 or almost 40 curated videos specifically for realtors on our YouTube channel. So I will also email you where you can get other awesome information about mortgages for realtors and information. So have a great day. We'll sell a house. Okay, bye.